Volatility is a pretty simple concept, but it's one that every single investor should really understand because it gets tossed around.
Market volatility is unavoidable. It is like markets to fluctuate in price over short periods. Wide price fluctuations and heavy trading are typical characteristics of volatile markets. Welcome back. Here we are again with another exciting video, giving you the reasons why stocks are oh so volatile. It's important to remember that market volatility is unavoidable. Markets are designed to move up and down in the short term. It is incredibly tough to time the market.
To thank you for watching this video, we're offering you an absolutely free training webinar. Do you want to learn the secret of improving all aspects of your life and unlocking what you're really capable of? The legendary Bob Proctor spent over 57 years learning this one thing and is hosting a free webinar where he reveals what he's learned and what actually works. He'll teach you the law of compensation, a secret only the mega wealthy know of but not taught in our educational system, and the impression of increase, the law of laws that will increase areas in all aspects of your life, whether it be in health, relationships, or wealth. Right now, the first 200 people to use the link below will get access to this free webinar. Now, let's get back to the video.
Stock prices fluctuate continuously owing to supply and demand swings. A stock's price will rise if more people try to buy it, while a stock's price will go down if people try to sell it. The supply and demand relationship is extremely responsive to current events. Maintaining a long-term view while ignoring the short-term volatility is one way. If you let it, the market will chew you up and spit you out. Don't! Be strong and cautious at all times. There are a lot of good deals available right now. This is a sound strategy for many investors, but even long-term investors should be aware of unpredictable markets and the procedures that can help them weather the storm. Market veterans, on the other hand, see such a huge movement in sentiment as a symptom of the type of volatility that affects bear markets. Because when the volume is low, as it is in bear markets, the activities of small investors can have a significant impact on stock prices. Many investors become startled during periods of high volatility and begin to doubt their investment methods. This is especially true for inexperienced investors, who may be tempted to exit the market and wait until it appears safe to return. Although stock market volatility may appear to be frightening, investors must succeed. It is for that reason that excellent enterprises can be purchased at fantastic prices. Volatility is a statistical measure of a market's security or tendency to rise or drastically decrease over a short period. The standard deviation of an investment's return is commonly used to calculate it. The term standard deviation refers to the amount of variation or departure that can be expected in a given situation. The fact that there's a company behind every stock and the reason why firms and their stocks perform the way that they do, according to Peter Lynch, is crucial to remember while investing. Wide price fluctuations and heavy trading are typical characteristics of volatile markets. They are frequently the result of one-way trade order imbalance, all buys and no sales. For example, economic releases, company news, a recommendation from a well-known analyst, a popular initial public offering, the IPO, or unexpected earning results, according to some, cause volatility in the markets. Investors, particularly those who use an online broker, should be aware that many firms adopt techniques to reduce their exposure to extreme market risk during periods of high volatility. Some market maker businesses, for example, have in the past temporarily suspended routine automatic order executions and processed orders manually. Let's start by knowing the difference between a volatile stock and a volatile market. When we talk about volatility about a specific stock, it indicates that the price of the stock is changing, about more than usual, and this is referred to as a volatile stock. When we talk about a volatile market, on the other hand, we're talking about the stock market's large up and down moves. Reason number 1, inflation, interest rates, and exchange rate impact. Periodic interest rate increases by the United States Federal Reserve to combat inflation are one of the more predictable influences on the stock market. When interest rates rise, many investors sell or exchange their higher risk equities for government-backed securities like bonds to take advantage of the higher interest rates they offer, while also ensuring that their investments are protected. Changes in exchange rates will increase or decrease the cost of doing business in a country, which will affect the price of stocks of businesses doing business overseas. While basic market forces such as supply and demand and purchase price parity determine long-term exchange rates, short-term swings are influenced by news, events, and futures trading and are difficult to forecast.
To thank you for watching this video, we're offering you an absolutely free training webinar. Have you ever wondered how to end procrastination and self-sabotage so you can unleash your full potential to live the life you deserve? #1 best-selling author and high-performance coach Peter Sage is hosting a free webinar where he'll teach you how to increase your wealth with less time and struggle. and also how to hyper boost your growth and success so you can finally break out of any rut you find yourself in. Right now, Peter and his team are offering a free $100 gift to anyone who doesn't find his webinar as the best use of their time within the last 5 years. Now, let's get back to the video.
Reason number 2, hype and financial reports. Stocks in the stock market can also be impacted by the social coverage of a firm or introduction of new products or services. Many individuals and organizations are interested in promoting specific stocks and industries to increase the value of their shares and profits. And positive financial reports in stock market newsletters, internet blogs, press releases, and news reports can raise a high expectation for the company's performance, causing stock prices to rise. This can happen even if the excitement is unfounded. Investors would be wise to evaluate how people react to the hype rather than the merits of favorable marketing. Respected stock market authorities such as Warren Buffett, Peter Lynch, and hedge fund investor and financial speculator George Soros can advance hype and its opposite. Such is the respect accorded to these individuals' skill and past successes, they can sometimes influence market movement by simply suggesting that developments might occur. Reason number 3, impact of world events. World events such as war and civil unrest, natural catastrophes, and terrorism can have an impact on the company's stock prices and the stock market in general. These effects might be direct or indirect, and they frequently occurred in series. Financial markets will be influenced by any global occurrence that has an impact on firm cash flows or corporation valuation, interest rates. The discounted value of all future cash flows determines the company's value. If the company revenues decline as a result of a global event such as COVID-19, stock prices will fall to reflect lower future earnings. In a similar vein, if demand for a commodity fails, the price of that commodity will fall as well. Volatility in the financial markets simply refer to the price of movements over time, and it is caused in part by uncertainty. Financial market volatility increases when economic and financial uncertainty increases. COVID-19's influence in economic growth and corporate profitability is currently a source of considerable uncertainty. As a result, financial market volatility has increased and is expected to continue to rise until uncertainty is resolved. We can also see that both S&P 500 and the DJIA experience a single structural break in terms of return, predictability, and price volatility. The split could be linked to COVID-19, or more particularly, stock sell-offs by the US Senate committee members before the market crisis caused by COVID-19. Furthermore, after the derived split, both return predictability and price volatility increased dramatically. The following are some significant implications. On one hand, crises might be viewed as a source of opportunity. COVID-19 is a major cause of market inefficiency, which provides traders and speculators with valuable possibilities. Before making any stock market decisions, rational investors who want to optimize the returns should pay a special attention to insider trading. On the other hand, crises can exacerbate income and wealth disparities by allowing market participants with ample liquidity to seek stock market profit. Now, reason number 4. Speed of information. Market analysts find distinctions in the current bear market compared to prior downturns, even though there are some similarities. For one thing, no bear market has ever had such rapid transmission of information via electronic media, nor has any other bear market ever had the ease of trading that this one does. The speed at which prices adjust to integrate new information can be used to determine the degree of efficiency in the stock and futures markets. This process might be slow or fast, depending on how long it takes for pricing to reflect value changes. Prices may also reflect patterns that move away from equilibrium or give rise to under and overreaction occurrences in very short intervals or over long periods. This has added to the turbulence. Compared to prior bear markets, it's been exaggerated, says Quincy Crosby, chief investment strategist at the Hartford. Everything is swift and instantaneous with automated trading. The spread of worldwide information and gossip have all worsened the problem. The fifth reason is that traders engage in swing trading. The types of market swings that have caused Dow to swing 1,000 points in a single day simply require putting in the old buy dips, sell the rally strategy on steroids. Not even, especially this violent. Crosby adds that when asked if bear market rallies can be this severe, sell into strength has always been a feature of these rallies. She explains, "The volatility we're experiencing, the swings are indicative of a bear market," says the analyst. Mergers and acquisitions, earning reports, dividend suspensions, the development or approval of a new creative product, the hiring or firing of business executives, and allegations of fraud or negligence are just some of the developments that can affect the price of a company's shares. When these internal developments are unanticipated, stock price movements will be most dramatic. Such swings tend to be stronger in terms of profits and percentages as trend picks up momentum, and the market gets closer to reaching the bottom. And they can happen later in the day, especially if the market is at an extraordinarily high or extremely low level. And thus, we have come to an end today with these many reasons for stock volatility. If you liked the video, do like and share it, and do subscribe for more.